Good morning, ladies and gentlemen. Welcome to this latest webinar. We're delighted to co-host, along with our friends and partners, HVS, Bird & Bird, AlixPartners, and EP. Today we ask the key question in relation to operating models, and what is the best operating model for hotels in this marketplace? All across the world, there seems to be a leaning towards different models. So again, it'll be really interesting to hear the different views today, and to understand the pros and cons of each model. We're fortunate to possess an exceptional group of people coming together today to help us guide us through this landscape. So we look forward to the next hour and a half, and I promise we'll try and finish by 10:30 promptly for you. Of course, there's all kinds of questions to be raised, and the first question, which may sound a bit obvious and strange at the same time, is about COVID. Has COVID changed this landscape? Has it changed the conversation? I don't think anyone actually almost talks about COVID anymore. The world's moved on, but has business moved on in the same way? Or are we back to the conversations of pre-COVID? I'll be interested to hear those answers. And if not, what has been the impact of COVID, and what's the ramifications of that into the long term? How do our experts view the future landscape? Overall, this year seems to be encouraging. We seem to be on the road back to a recovery. Transactions seem to be on the rise, and with more private investors dominating the marketplace. There's a forecast of 19% increase in global air travel in 2025, which actually is better than the forecast just 2 years ago. What's the impact of that, and how that's going to impact on the industry as well? London alone is going to see 1,900 new luxury rooms by 2025. And RevPAR in May 2023 has been up 22% against 2019. These are encouraging figures. Whatever the politics, whatever the economic landscape, however difficult it is, there are good signs of a recovery in process. So the picture is one of light at the end of the tunnel we've all faced and all the challenges. And it has been remarkably difficult for operators over the last few years. So what is the discussion today? Is it different to how it was in 2019? And what's it going to look like going forward? So I look forward to hearing all our experts talk about this subject over the next hour and a half. Izzy, can I ask you to raise a few polling questions for the audience before we start? Now, we've got 6 polling questions for you, so I'll be really interested in your thoughts. Number 1, which type of operating model for your business is your business actively involved in at this present moment in time? Question 2, which type of operating model is your business expecting to be involved in the coming 6 to 12 months? Three, how do you view leases as an operating model now compared to pre-pandemic? Question 4, how do you view management agreements as an operating model now compared to pre-pandemic? 5, how do you view franchises as an operating model now compared to pre-pandemic? 6, how do you view owner-operators as an operating model now compared to pre-pandemic? You can see the same trend. Have a look at the results. Interesting question 1, which type of operating model is your business actively involved in? Obviously, we've got 68% on management agreement, 46% on lease, 44% franchise, 39% owner-operators, and nicely split across. Which type of operating model is your business expected to be involved in? Management. So is that almost the same? Owner-operators falling a little bit. Those figures, but interesting. How do you view leases as an operating model now compared to pre-pandemic? It's a split. Interesting. How do you view management agreements as an operating model now compared to pre-pandemic? That's natural. 5, how do you view franchise as an operating model now compared to pre-pandemic? It is interesting about how the conversations are going to flow. And how do you view owner-operators as an operating model now compared to pre-pandemic? Great, thank you very much indeed for that. That's great. Really interesting to see. Now we do have a Q&A button at the bottom, so please do ask questions as we go, and we'll try to make sure we answer all your questions, either through the session itself, as we do the Q&As and the questions, or we'll get someone to come back to you and answer afterwards as well. So please do ask as many questions as you feel fit. But please enjoy the session. And now, firstly, I'd like to introduce our first presentation, which is Karen Friebe and James Fowler from Bird & Bird. Karen. Hi, welcome. Welcome, James, and good luck. I'll hand over to you now.
Good morning, Chris. Thank you very much. I'm Karen Friebe. I'm the head of Bird & Bird's Hotels, Hospitality and Leisure team. And along with our senior associate, James Fowler, to whom I will introduce you in a moment, we're going to be briefly setting the scene for today's talk by describing some basic elements of the three key models that are going to be discussed by today's panel, namely leases, hotel management agreements, and franchise agreements. So I will briefly outline for you some of the key terms of a typical hotel lease. Then I'll pass over to James to talk about hotel management agreements and franchise agreements. James will in turn hand over to Chris Martin of HVS, and Chris will add some further market colour to these three types of holding structure. So first of all, let's have a look at the key elements of a typical hotel lease. So you'll see here some green shading on the left and blue shading on the right. The green is where we've highlighted the key elements, the key issues in relation to leases for landlords. So some of these are quite basic, I understand, but we thought it was important to set the basics down. So a landlord will own the freehold or perhaps own the head lease of the property in question. The landlord generally has no responsibility for or involvement in the operation of the hotel. That's down to, for example, the brand or whoever the appointed operator might be. The landlord also retains approval rights, which can be quite hotly contested. For example, over what alterations the tenant is permitted to carry out to the hotel property. It retains approval rights commonly over dealings with the hotel property. So that's as to whether the tenant is permitted to assign or underlet the whole or part of the property. And the landlord also will generally have approval rights into whether or not the tenant is permitted to grant hotel management agreements and franchise agreements in relation to the operation of the property. And of course, commonly the landlord will receive rent from the tenant. From the tenant's point of view, the tenant will have exclusive possession for an agreed term. That can vary greatly. It can range between anything from 10 years, although I think that would be quite unusual. And I have seen leases that go through to hundreds of years, 200 years, particularly if we're looking at a ground lease. But we tend to usually see leases that are for a minimum term of 15 years. The tenant pays rent to the landlord. That could be a fixed amount, subject to review at agreed intervals. It could be based on turnover, or it could be a combination of both. And there are obviously other options that might be agreed between the parties. The tenant may appoint a manager to operate the hotel on its behalf under an HMA, or it may operate the hotel itself, for example, under a franchise agreement. So those are just some of the basics, and I'll now pass over to James, who will cover hotel management agreement basics and franchise agreement basics for us.
Thank you very much, Karen, and good morning, everyone. It's a pleasure to be here with you. So we'll take a look first at some of the key aspects of hotel management agreements. So in a hotel management agreement, the owner owns the hotel and the hotel business. So here we're talking about more than just the property and the structure of the hotel, but we're talking about, for example, inventory in the hotel, contracts with customers and suppliers, and including typically, but not always, the staff of the hotel. So the owner owns the whole of the hotel business. The owner then appoints the manager to operate the hotel on behalf of the owner. And the manager does that as the agent of the owner, because the business ultimately is the business of the owner. In terms of the financials, the owner will fund the initial conversion and fit out of the hotel to meet the manager's brand standards, and then will be responsible for funding all of the ongoing capital and operating expenditure that needs to be incurred in connection with the hotel. By contrast, the manager will provide the brand and the brand identity, the brand look and feel, and the operational know-how that it will use in order to manage the hotel on behalf of the owner. And so in the early stages, it will provide technical services to the owner in return for a fee to ensure that the hotel is initially designed in such a way as to meet the manager's brand standards. It will then operate the hotel under its brand, and normally it will provide certain chain-wide services to the hotel. Typical types of chain-wide services include the reservation system, marketing programs, and loyalty schemes. In return for the services that the manager provides, it will be paid management fees. Those usually are comprised of a base fee, which is calculated as a percentage of the revenue that's generated by the hotel. Typically, we see this being in the range of between 2 to 4%. And then it will be paid an incentive fee based on a percentage of operating profit to the extent that operating profit is generated. And we typically see an incentive fee being in the range of 8 to 10%. After payment of the operating expenses and the manager's fees, the remainder of the profit then goes to the owner, because ultimately, as I mentioned at the beginning, it is the owner's business. So we'll move on now to look at hotel franchise agreements. Some of the elements here are the same, and in this scenario, it's worth pointing out the owner of the hotel and the hotel business in this instance is the franchisee. So again, similarly to the previous slide talking about hotel management agreements, the franchisee or the owner owns the hotel and all of the assets comprising the hotel business. It will convert and fit out the hotel in order to meet the franchisor's brand standards. And then it will fund all of the ongoing capital and operating expenditure that needs to be incurred in order to operate the hotel. From the perspective of the brand, the franchisor, again, there are some similarities. The franchisor provides the brand, it provides technical services to the franchisee in order to ensure that the hotel is fitted out to meet the franchisor's brand standards, and it will provide similar chain-wide services to those we looked at on the previous slide. Where there are some key differences, well, the franchisee, the owner, in this instance, does operate the hotel on an ongoing basis, and it does so on its own account. So the owner is responsible for all of the operation of the hotel. The brand, in this instance, is the appointing party. So it appoints the owner to act as one of its franchisees. And because it's placing its brand and its reputation in the hands of a third-party operator, it will then conduct periodic quality assurance audits to make sure that the operation is in keeping with its brand standards. In terms of the financials, again, the owner pays a fee to the brand, but in this case, it's franchise fees. This is usually a fixed initial fee calculated per key normally, and then an ongoing royalty usually calculated as between 1% and 7% of revenue. So to conclude our presentation, we'll move on to take a look at some of the reasons why investors might wish to invest in these different types of models, and perhaps some of the reasons why they might think twice about doing so. Karen will talk about some of the pros and cons of the lease model, and then I will finish on some of the pros and cons of the management and franchise models.
Thank you, James. So this slide shows you a sort of basket of things that you might want to consider with each of these three models. With a lease, the landlord might be happy with the fact that it needs limited hotel expertise because it basically passes that over to its tenant. The landlord generally has no responsibility for hotel operations, whether financial, operational or legal. It will try and pass all of those over to its tenant. The landlord will receive a predictable income stream and an attractive, hopefully saleable capital asset. But when I say an attractive asset there, obviously, the landlord will want to protect its asset by including protections and obligations on the tenant, for example, to regularly upkeep the property, to deal with repairs, and probably to refresh fixtures and fittings at sensible intervals. In this model, the hotel will arguably be easier to finance. This is a topic that I'm sure will be covered by our panel. There's long been a debate as to whether the lease model is the most attractive to lenders or whether lenders should be more amenable to other models. With a lease, a landlord has limited market and operating risk. And one of the biggest issues, of course, is that the tenant repairs and reinstates the property. And I remember when the asset-light model was first adopted on a large scale, back, I think, in the early 2000s by companies like IHG, one of the main drivers was that tenants who held property, who held freehold or leasehold interests, hotel operators, for example, would say, well, this isn't really our area of expertise. We're not in the business of looking after property and paying for repair of holes in the roof. We're a brand. Our expertise lies in running the operation. So we would like to travel asset light and put those responsibilities onto another party, namely a property landlord. So that's some of the upsides with the lease. On the downside, perhaps a landlord might think, well, a lease doesn't give me much control over the hotel operations. I have seen a number of landlords who try and get some control under the terms of a lease, but those can be quite heavily negotiated issues and discussions. The tenant will receive the trading upside, of course, after it's paid the rent, and some landlords might find that a little bit unattractive, but of course that's all about getting your rental levels right. And a landlord will, with a lease, have less control over the hotel's positioning. That may matter to some landlords and it may be less important to others. James, over to you to talk about HMAs.
Thank you very much, Karen. So taking a look at some of the pros and cons of the hotel management model. This is a model, similarly to leases, that may appeal to investors who either don't have a particular hotel expertise or don't wish to have the responsibility for the running of the hotel. Because under the management model, the owner appoints an expert manager to run the hotel on a day-to-day basis on its behalf, there's limited hotel expertise needed and limited responsibility for the operation of the hotel. Now, the flip side of that, of course, is that there is limited control over the hotel operations. And as we mentioned on the previous slides, the business is ultimately the business of the owners that is then being put in the hands of a third party. And that may be a downside to some investors. Another benefit of the model is that an owner investor can leverage the manager's brand and expertise. So, for example, partnering with one of the big international chains means there's less of a risk taken on establishing a good brand and a good operating model. You can just engage someone who already has all of those things. The flip side to that, of course, is that you're tied to brand standards and chain-wide systems that can require quite a lot of investment to comply with. From the financial side, the owner gets the trading upside after payment of fees and the operating expenses. And there is some input and approval over budgeting, although this is an area that is quite hotly contested in hotel management agreements. And there's a view that if you have a good hotel and you've engaged a very good manager, then it's relatively easier to obtain finance. In terms of some of the downsides, under a hotel management agreement, an owner will often have limited recourse against a manager. The manager's argument in this respect will be that although they are responsible for managing the day-to-day operation of the hotel, because their upside is limited to only their fees and they don't participate in any remaining profit, they should not have extensive liability for anything that goes wrong in the hotel. And usually a manager will only accept responsibility for liabilities that arise as a result of their gross negligence or willful default. Another downside from a potential investor is that, as we looked at on a previous slide, some of the fees are based on revenue rather than profit, and those will be payable even if the hotel is ultimately loss-making. Looking finally at the franchise model, the difference here is that the franchisee, in this case the owner, will have full control over hotel operations within, of course, the context of the brand standards with which they are required to comply. This might therefore appeal to owners who aren't, or investors indeed, that aren't comfortable with the idea of placing the operation of their business and their asset in the hands of a third party, but still want to leverage the established brand, systems, customer base, and operational know-how of the franchisor. And of course, with that control over the day-to-day operation of the hotel comes greater control over the incurring of operating costs. So again, some owner investors see this as a way to have greater control over their return. And again, in this scenario, the franchisee gets the trading upside after it's paid the franchise fees to the franchisor. We're looking at some of the challenges of this model. Of course, the nature of being involved day to day in the operation of the hotel means that you need to have very good hotel expertise. And there is full responsibility from a financial, operational, and legal perspective for the operation of the hotel. Because your hotel would be part of a broader network of hotels in the franchise model, there's also a lack of control over brand reputation. A breach or an issue that arises in another hotel within the network might affect the reputation of the whole brand network, and therefore might affect your business even though you had no responsibility for that particular issue. Looking at the agreements themselves, franchise agreements are typically very pro-franchisor, and there's often much less leeway to negotiate them than with, for example, a hotel management agreement. There's often a lot more imbalance in the negotiating power of each party. Again, being part of a branded network means that you are tied to potentially costly brand standards and chain-wide systems. And again, franchise fees are usually based on revenue. And so even if your hotel is ultimately loss-making, the franchisee is ultimately liable to continue paying those fees. So thank you very much. That's just been a whistle-stop tour through the three models that we are looking at today, but hopefully gives you a good grounding for all of the discussion that's to come. And so with that, I would like to hand over to Chris, who will add some colour and some market insight to everything we've talked about so far. Thank you very much.
Thanks, James and Karen. Apologies, everyone. I've wound up doing this from the other side of the world somewhat unexpectedly, and I'm having some technical issues. So Izzy is very kindly in the background going to be changing slides for me. I suspect that I may have here quite a bit more material than we have time to get through, but we'll give it a go. We'll see how far we get. As usual, in these sort of webinars, we've got a mixed audience, and we've got some very experienced investors and some less so. So some of this might be pretty obvious to some of you, but hopefully most of you might find something of a bit of interest. I'll just announce slide numbers as I go so that hopefully the changes work well. So slide 2, just a quick overview. In the 15 minutes I've got, I'm trying to touch on quite a bit, but this is a highlight of what I'll try to get through. So first, a few points on hybrid lease structures, then some of the learnings that came out of the pandemic in relation to operating agreements, then a bit of a focus on franchise and third-party operators, And then if I've got some time at the end, a few points on a few sort of current trends, I guess, franchises, guarantees with annual caps, and franchisors guaranteeing third-party leases, third-party operator leases. So slide 3, hybrid lease structures. Some people who've spent their entire careers working in Europe might not realise to what extent leases are very much a European thing in the hotel industry. They're far less common in the US and Asia. HMAs have always dominated in those markets. The first 10 years of my career, I was in Australia and Asia, and probably only dealt with a handful of leases. But in Europe, the lease has been, very, very strong, clearly. And up until, 15, maybe 20 years ago, certainly some of the major global operators were also offering leases, although certainly less so now. Apart from various budget operators, though, fully fixed leases have now become much rarer. This is mainly due to, firstly, changes in accounting regulations that have forced tenants to take a lot more rent liability on their balance sheets than they used to have, than they used to need to. Secondly, pressure from stock market analysts and investors. They want operators to be operators and use their capital that way, not invest in real estate and undertake big balance sheet liabilities from leases. And thirdly, many traditional lease investors now want to get some of the upside, which is fair enough. In response to this, turnover rent elements have become far more common, which provides upside potential for the owner. And for the tenant, it reduces their balance sheet impact and risk. And such a structure more closely aligns the owner and tenant interests. For the owner, there's clearly more risk than with a fully fixed lease, but also more upside potential when trading is going well. Of course, turnover rent elements are often combined with a minimum fixed rent, but of course a lower fixed level than there would be, if there was no additional turnover upside for the owner. Then slide 4, please, Izzy. Just a bit now on NOI or EBITDA-based leases. So we first started coming across these type of structures, I guess, more than 15 years ago, and we thought they'd be more common than they probably have been so far. Basically, they're a form of operating agreement that behaves very much like a management agreement, but with a minimum guarantee. But they're legally still lease agreements that can still satisfy a lot of institutional investors because the operator or the tenant employs the hotel staff, not the owner, as under a management agreement. Typically, these type of agreements involve a minimum annual rent, plus the majority of the upside, circa sort of 90% or so, say, going to the landlord. There's a cap guarantee to cover the minimum annual rent, which varies, but generally say around 2 times the stabilised minimum annual rent. The tenant deducts a base fee as well as an FF&E reserve before the calculation of the upside. And then there's a top-up mechanism if the guarantee is drawn down. So in the following years, part of the tenant's share of the upside goes back into the guarantee. We think this should probably be about half, about 50% of what is otherwise effectively acting as the operator's incentive fee if the guarantee has been drawn upon. So as you can see, this structure is basically a management agreement where the operator is paid fairly normal base and incentive fees. Again, the incentive fee being their share of the upside. So in this example, a 10% incentive fee effectively. But there's also a minimum guarantee, a minimum guaranteed rent with a cap. But it's still legally a lease, so the tenant operator employs the staff. Quite importantly, though, in this type of structure, if the developer wants to sell to an institutional investor, the minimum annual rent needs to last for the entire term, not part of the term. As an example, we helped a developer a few years ago who wanted a lease, and this was for a new 5-star development. We eventually convinced a global operator to agree to this type of NOI-based lease structure for something that was, of strong strategic value to them, so it was something they really wanted to win. Importantly, in that example, the minimum annual rent was guaranteed through the entire term of the lease. Then the same developer did a second hotel with the same operator, But second time around, the operator would only agree to the minimum annual rent lasting 10 years, not the full length of the lease. The first hotel was then sold to an institutional investor, but the second one fell over because the rent became fully variable after year 10, which meant the institutional investors couldn't acquire it. Slide 5. So I'm going to run through a few sort of COVID lessons, a few things we probably knew about, nothing earth-shattering, but some things that the pandemic showed us. Firstly, for leases, in many cases, as we know, we've certainly discovered a lease doesn't really protect an owner against major economic shocks. While we had seen this to some extent in previous major downturns, the extremes of the pandemic really brought this home. I mean, basically, if your tenant is not generating any cash to pay the rent, you can't replace them under similar terms with someone else. No one would step in that situation. So then you've got to negotiate with your tenant. Owners with the financially strongest tenants were clearly the best placed during the pandemic, but increased security is very much against the general trend in leases of cap guarantees these days. So this therefore negates one of the major attractions of leases, which is the acceptance of a lower return as a trade-off for lower risk. But then again, some investors are still always going to need leases because they can't employ the staff and they can't have fully variable investments. The next slide, slide 6, some COVID learnings for management agreements. In regards to HMAs, the pandemic made a lot of owners understand that variable central fees based on a percentage of revenue are much better than fees that are based on fixed amounts per room that you still need to pay even if you have a hotel that's not operating under the contract. So clearly operators felt the pressure too, and without any fixed fees at all, and almost all hotels closed, they would have been in significant trouble. But a balance between more variable over fixed is certainly something that operators started to address during the pandemic by restructuring some of these fees. We also saw some operators agreeing to standstills on development deadlines so that, for example, tech services and some pre-opening fees didn't just automatically increase if development milestones weren't met. So they agreed to stop the clock there. Some operators allowed owners to borrow from FF&E reserve funds during the pandemic to keep things ticking over. Some even provided short-term loans to help developers complete some new projects. And there are also situations where an operator might have agreed to convert an HMA to a franchise. So again, some operators responded probably better and more quickly than others, but most came to the party and were willing to look at ways to work with owners to try and get through the situation. Slide 7 now, please. Some COVID lessons re franchises. Okay, again, revenue-based fees are much better protection for owners compared to fixed fees. Same thing with the franchise. We also generally saw franchisees being able to react quickly in reducing their hotel's costs, which is obviously very important when you don't have any revenue. Also, as a franchise often means you also have a third-party operator. That usually means you've got a more flexible HMA, which was helpful when you've got a pandemic going on. Some brands also agreed to short-term reductions and even stand-asides on franchise fees for up to a few years, particularly where there was a situation where a franchisee had rental obligations to an owner and they were under pressure trying to perform to that and come to an agreement with an owner if there may need some slight adjustment there. Are we going for time? Not too bad. Slide 8. Just a bit of a focus now on franchise and third-party operators. We all know franchise is the fastest growing form of operating structure. To highlight this, from 2008 to 2022, the percentage of the major global hotel companies' hotels in Europe that were franchised versus managed, owned, and leased increased from about 40% in 2008 to about 60% of total hotels. Again, this data is based on number of hotels, not number of rooms, but the trend is still very clear. On the next slide, slide 9, there's a bit of a quick comparison with the US. The table there shows the extent to which franchises dominate in the US, where an amazing 91% of the big brands' total hotels combined are franchised today versus the 60% in Europe. I also think it's fascinating to note that Aimbridge, who are the world's largest third-party operator, operate almost twice as many hotels in the US than do any of the major brand operators. So yeah, quite extraordinary, and probably that's the direction we're heading in Europe. How are we going for time? Am I okay to press on? Or was I supposed to be finished on the half hour?
Oh, you're absolutely fine, Chris. Please press
Great.
on.
I'll press on a bit further. Thanks. So slide 10, a quick focus on franchise and third-party operators. I think it's fair to say that most people in our industry feel that as the big global hotel companies have grown bigger and bigger, their most important strength has clearly become the immense value of their brands and their systems, which has made franchising increasingly attractive. Traditionally, most franchises were for limited service and extended stay properties, and typically for small to medium-sized hotels. But now franchises of full service and much larger hotels are also very common. What is not common at this point is franchising of luxury hotels, and there's very little for franchise hotels. In both situations, obviously, because the brand owners want to have much more direct control over the operating standards. Slide 11 now. So the growth in franchising has certainly coincided with the rapid growth of third-party operators. Some of the key advantages of management agreements with TPOs are that these agreements tend to have much shorter terms. This is obviously from an owner's viewpoint. The advantages, these agreements tend to have much shorter terms. They're much more likely to have termination provisions on sale. They're much more likely to have lower management fees and more incentivized management fee structures. And TPOs have a particularly strong focus on cost control. They're very hands-on with controlling costs. But the owner has to pay both franchise fees and management fees to the third-party operator. So there needs to be enough upside on the bottom line to outweigh these costs, but there often is. Okay, slide 12. I might even get through this, all this material. Just a few quick trends, a few other trends to talk about. Firstly, franchise, flip to franchise. While some major operators are resistant to this, mainly because they don't want to go through all the effort of establishing a new hotel under their management and then having to change it to a franchise and therefore lower their fees somewhat. Apart from that, an increasing number of owners are attracted to the flexibility that franchising offers, and some operators are certainly prepared to entertain it. I'd point out that as an owner, you also need to negotiate the major commercial terms of the franchise agreement when you agree the HMA. As James and Karen were saying earlier, franchise agreements are certainly less flexible, but most of us know that there can be, depending on how strategic it is, again, for the operator, for the brand owner, there can be a little bit of flexibility in some of the key commercial terms. So you need to agree those right up front when you agree the HMA, unless you're prepared to just accept whatever the standard franchise terms are at the time you flip. Then slide 13, guarantees with annual caps. Operators have increasingly sought to introduce not just total overall caps, but also annual caps on any guarantees in recent years. Our view is that in most cases, these annual caps mean that the operator is only really risking part or maybe all of their projected incentive fees, and they'd still earn their base fee regardless. If that's the case, really what this is more like is an owner's priority return. We have, though, been involved in negotiations quite recently to, instead of having any guarantees at all, having a good, strong owner's priority level, and where both the incentive fee and the base fee are subordinated. Now, obviously, this needs to be, again, something that's very strategic and for the operator and something they really want. But you know, it's not something that's that is not impossible to achieve in the right situation with the right operator. One other issue, though, I'd say with this type of structure is that an owner should protect themselves against a situation where an operator may not be earning any management fees at all because their projections were stronger than actual performance turns out to be, and they're not hitting the OPR levels, and they might not have any realistic hope of exceeding them. In that sort of case, they might be a little less motivated to operate the hotel to its full potential. And so in some such cases, an owner really also needs to build in some sort of a termination provision if that's where it gets to. And then my last slide, number 14, another trend we're seeing recently is franchisors guaranteeing third-party operator leases, where the brand owner provides a cap guarantee that stands behind the third-party operator's cap guarantee. Then there's typically there'll be an escrow account put in place to hold a percentage of excess operating cash once the TPO, the lessee, has paid the rent, and that's used to build up an escrow account that will then replace the franchisor's guarantee at a certain point in time once it covers it. Just one of the things I'd point out here that I think is very important for an owner in this sort of situation, if they're looking at this sort of deal, is to absolutely make sure that the franchisor is properly on board up front. Otherwise, further down the line, you might think you've got to deal with the tenant, and then you might find out that the franchisor's investment committee looks closely at the numbers a little bit later on and thinks the deal might be a little too bullish. And then you've spent a very long time getting tied up in a situation where you might not have the deal you thought you had. It might need to be slightly recut. So that's the end of my presentation. I hope most of you might have found something of some interest in there somewhere.
That was great, Chris. Thank you very much indeed. And thank you. I know you've obviously had quite a lot of travel, so well done for doing that. That's very impressive. Chris, before you go, can I just ask, there's a couple of Q&A questions. If I could just ask that you have a look at those and see if you can answer them. We've also had some requests to look at the polls again. So Izzy, can you bring up the polls just before we hand over to Graeme? So just to quickly run through these again. So apologies if anyone didn't pick up the results. So just going back to question 1, which type of operating model is your business actively involved in at this present time? Obviously 46% lease, 68% management agreement, 44% franchise, and 39% owner-operator. Then going to question 2, which type of operating model is your business expected to be involved in the coming 6 to 12 months? 46% lease, then 67% management agreement, 45% franchise, 30% owner-operator, and 10% none of the above. Question 3, how do you view leases as an operating model now compared to pre-pandemic? 44% less favourable. I think it's really interesting. 45% the same, and 12% more favourable. We will send these out as well afterwards, so if you don't catch on, we'll just go through it. And then 4, how do you view management agreements as per operating model compared to pre-pandemic? 9% less favourable, 48% the same, and 44% more favourable. 5, how do you view franchise as an operating model now compared to pre-pandemic? 11% less favourable, 52% the same, 38% more favourable. So it's interesting the kind of points they raised. And then 6, how do you view owner-operators as an operating model now compared to pre-pandemic? 27% less favourable, 37% the same, and 37% more favourable. As I said, we will share these, rest assured, but it raises some interesting points, I think. Thank you very much. Thanks, Izzy, for doing that. Chris, thank you for your contribution. That was great. Can I just ask you to go off camera now? And can I introduce Graeme Smith to come and join us, please? Thanks, Graeme, who introduced the panel, and I wish you well on this. Good luck.
Thanks, Chris. And thanks, Chris Martin, as well. It was a great session. So I'm Graeme Smith. I'm a Managing Director at AlixPartners. I co-lead the travel, hospitality and leisure industry here, and we're a global consulting and advisory firm. So really pleased to have a great panel here today, which is a mix of global brands, investors, and also operators. I'll just introduce the panel quickly now, and then just give an overview of the objective of the discussion. So we have Philippe Bijoui from Accor, who's the Chief Development Officer for Europe. We have Felicity Black-Roberts, who's Vice President Development at Hyatt. With David Kellett, Managing Director at Invesco. Jacob Rasin from Pandox, who's a Vice President of Transactions there, and also Sabina Reis de Corrado, who's VP Development at Aimbridge Hospitality. So we just get the panelists to come on the screen now, and then for the actual panel itself, the discussion really is to try and explore what impact, if any, the disruption caused by the pandemic had on the market for these different operating models that we've been hearing about this morning. Get a sense of what people are seeing in the market and how that compares to what we think the market should be doing given these learnings. So I'm going to start off just by posing a question to the brands. So Philippe, first question to you, and then I'll go around the panel. Which hotel operating models did you mainly work with heading into the pandemic, and how did you find that these held up to the disruption that was caused through that period?
Good morning, Graeme and all. The business model we use hasn't changed pre-pandemic and post-pandemic. We are doing management contracts, HMAs, and franchise. We are fully asset light for more than 5 years now, and we continue that way. And I don't see any difference, at least if I look at simple statistics in the number of contracts signed and the type of contract signed over the last 2 years and 2018, 2019 in the balance between franchise and management agreements. So no change. A lot of things have changed post-pandemic, but not in that respect, I would say.
Okay, great. And Felicity, how about at Hyatt?
Probably a very similar response in that, we were really pushing forward with our management contracts and franchises as a strategy. Hyatt, like Accor, had gone out on an asset light message and has stayed true to that. I think the difference we're seeing within Western Europe, and just specific to this region, is Hyatt historically didn't have many franchises in Western Europe. So our first franchise was in 2017. So actually our split between managed and franchised is much more now skewing towards franchise. But that's partly due to the fact that we're now building our franchise portfolio. So I think we're around 50-50 at the moment between managed and franchise. But that's grown, obviously, since 2017 from 0% of franchise.
And we are 60-40 between managed and franchise and managed. 60 for franchise, 40 for managed.
Yeah, which is probably where we're headed, to be honest.
Yeah. And from the investor perspective, David, how about you at Invesco? Have things changed from your investment attitudes pre-pandemic from an operating agreement basis to where we stand today, given the learnings?
Well, I guess no is the short answer, in that we've really gone with the hybrid lease model that Chris was just talking about, and that's been our model for quite a long time now. We're lucky enough to have a Hyatt one in there somewhere. I mean, there's a few brand ones lying around if you can find them, but they're quite rare, as the brands will no doubt tell you. I think perhaps the bigger point though is have things changed as a result of the pandemic? it certainly changes sort of how we look at structuring them a bit. I mean, there's some of that has definitely changed. But actually for us, we still like that hybrid lease approach. It also suits the capital that we've historically had. And I think quite a lot of it, and what you'll hear is one of the differences in Europe versus, say, the US or others has been, we've taken what is essentially a very operational business. The sort of the rent, if you want to call it that, changes every night. So, and we've applied lease structures to that, which are intended to sort of make these into core investments. So in, prime city centre locations, then that can obviously work. It's much harder to do in more sort of secondary or tertiary locations. Outside of Europe, you just haven't seen that because people have accepted it's more of a volatile income stream, and that's just how things are priced. So some of it is down to risk reward, some of it's down to the type of investor appetite, and it's about finding that right balance of risk and reward for the different contract types. So I actually don't think any of them is necessarily good or bad or better than the other. It comes down quite a lot to the risk reward appetite of the capital you're deploying against the investment case.
You talked there, David, about the hybrid lease. Did you find that structure allowed you the extra flexibility with the tenants during the pandemic to manage through that?
Yeah, I mean, you could say it would. I mean, the reality is that if you have good assets in good locations, then, and you have a direct lease with a brand, then they're not going to walk away from that property. So the secret of it is having good real estate where people aren't going to walk, right? If you have third-party operators, and I know Aimbridge doesn't do many leases, if any, right? So, or if you had the sort of sandwich lease model where you had the piece where there was the developer or whatever had stayed in for a little bit and then had a management agreement on the back, there was a lot more trouble because the incentivization for the tenant to pay their rent or keep the property was completely different from a brand, particularly if you've got their brand in a prime location, right? It's then really about the motivation and incentivization of the different parties. So again, it's so case by case. So the hybrid, yes, you take out a little bit, but there's still a big, reasonably big fixed rent component if you've got nobody coming through the front door, right? So it ends up in a discussion, right, at the end of the day.
And Jacob, from a Pandox perspective, obviously quite a heavy sort of lease portfolio within there. What have you taken from those learnings as you've headed through the pandemic disruption and out the other side?
Yeah, so we 159 hotels. The majority is variable leases with sort of a fixed guarantee, but we also operate ourselves. But I think we need to include the lease operator in the pre, during, and post. And I guess we can walk through the fixed, the variable, and the operating assets. And 2019, good for owner, good for operator. COVID, terrible for the operators, bad for the owners. And what we're seeing now is we're seeing increase in top line, increase in cost, and increase in interest rates. So we're all over the place now, I guess. But let's start with the fixed. If you had good rent coverage ratio 2019, it's okay for the operator, good for the owner. When we're going into COVID, absolutely terrible for the operator because the hotel is empty, but the sort of the lease payment stays. If you go into COVID as a owner with, I think with limited hotel experience needed, and you had a fixed lease, I would be worried what happens to that asset if the fixed lease operator goes under. And currently we're seeing, so post-COVID on the fixed lease, increase in top line, hopefully, but also inflationary cost increase, and as well as inflationary cost increase in the rent. So they're coming out of COVID, lean and hungry, and hopefully they get the top line, but they get also now this massive increase in cost as well as rent, because many of these leases are growth in terms of inflationary rent, right? Variable lease, good for owner, good for operator if we cut it right. During day one, I think our variable rent components are down about 35%. So day one rent discounts. And then you have the fixed components. Again, terrible for the operator, but better than fixed. Bad for owner. And what we're seeing post-COVID, and this is good for owner, good for operator. But again, we're all in this increasing cost interest rates. Operators is handling cost in operating expenses as well as rent, and we are in a different capital market scenario. The operating model, we have, I think our last brand management contract ended just after COVID, and we flipped that to franchise. But good for owner, good for operator. During, bad for both. We have the majority of the investment, but they're not getting any fees because no turnover, we're not getting anything. And currently, if you align the operator, as we have done on many of our management contracts today, we're in the same boat in terms of driving that result. So if the result is not good, it's not good for anyone. And if that result is good, both are sort of making money. And that's, so has it changed? Not really how we sort of seek the deals. We've done, so we're still seeking variable lease structures as well as operating assets. But yeah, I guess we're coming to that later on, but that's sort of the timeline we have experienced.
Yeah. And thank you. So, Sabina, I guess Aimbridge has the benefit of working with lots of different owners, lots of different brands, different territories, and we've heard in the US a pretty dominant position there. What about the learnings that Aimbridge have taken from the disruption and the different operating model styles?
Historically, we've always done HMAs, especially being a US company, as Chris mentioned in his presentation. And
also, I think you've frozen for me there. Is anybody else on the panel hearing Sabina? Okay, we'll come back to Sabina if she unfreezes there. What I'd maybe like to move on to now is we've talked a little bit about some of those learnings. It'd be great to just get perspectives on what people are actually seeing in the market at the moment. Is market behavior aligning to what we think the learning should be? David, you've mentioned sandwich leases as something there, and seeing that perhaps a little bit more prevalent in the market. What are you seeing going on in the market now when it comes to operating agreements and kind of behaviours of the participants?
Well, I'm glad you asked about operating agreements, not transactions, because that's a very short answer. Transactions. Look, I think it's interesting. Look, I thought that COVID would have a big change on operating agreements, right? I thought it would change things quite a lot. And I don't think it has changed things that much, really. I mean, there was sort of all this talk of pandemic clauses and things like this that came out of COVID, and you'd have 3 pages in the lease to say that effectively you would talk if there was another one. So I think really it goes back. I think what Jake was saying is spot on, right? It's about, you've got to really underwrite from the perspective of a hotel owner, whether you're doing a lease, a management, or a franchise, right? And it's the underwriting that's key. And if you get you get that as good as you can can then structure around it how you want to. So I think in a sort of post-COVID world, happier with maybe a slightly lower fixed rent, more variable, particularly with inflation. The higher variable rent is good, particularly if it's revenue based, right? Profit based, you've got all the other inflation challenges, but as an investor, that can work better. And I think you're seeing more protections come in. I know there's a question in the Q&A on ESG. ESG got nothing to do with COVID, obviously, but is probably the biggest thing. And you will see far more ESG clauses now in all of the agreements, be leases or management agreements. And it's an area where the brands in particular need to step up, because they are not always willing to back up in writing on the management agreement or their agreement and from what they say. So there's not necessarily hire an ACC or fault there, but it's something across the board in the industry where, as investors in real estate, we have so much regulatory pressure and other to invest into ESG, and it's important. We have to drive performance through that. But that's almost the biggest change, but it's got nothing to do with COVID. And then the COVID changes, look, I think it's probably just really, really getting into the underwriting at the end of the day, and then getting structures that are really well aligned between landlord, tenant, or owner, operator, whatever you want to call it, which, is probably was ever thus, right? But it's so there are some changes, but maybe not as many as you might have thought there would have been.
Lucy, just jumping over to you, just on the brand side, and I see we have Sabina back on, so I'll come back to you in a moment. What are you actually seeing in the market? What are the models that people are pushing? I thought one of the interesting answers I thought from the polls at the start of the session were that almost all operating models were viewed more favourably post-pandemic, other than leases. But what I hear in the market at the moment is that, well, everyone's running around desperately trying to sign up leases. So what are you seeing? Oh, you're just on mute, Felicity.
Still the mute button evades me after all these years. I think it's interesting, like you, when I saw the poll results, we still see a hell of a lot of RFPs, and maybe even more coming through for leases post-pandemic. And actually we're seeing quite a lot of RFPs when it's, pitch either for management or for lease, which we kind of didn't see so much of pre-pandemic. So it's almost David's point that people are keeping their options a little bit open and working out where the underwriting will fit best and how they can best make the transaction work. So I wouldn't have intuitively said, from what we're seeing, a flight from leases, albeit the poll said something different. I think what we are seeing, though, is and we see it very much on our management contract negotiations, is this kind of shifting of risk away from the owner of the real estate towards the brand. So we're seeing a lot more pressure, not just on the commercial terms, but on what I call commercial protection terms, things like guarantees, owners' priorities. To some extent, even where I've kind of said to the person on the other side, this isn't our real estate and it's not our business. We're operating it for you, and we're not taking any of the upside here. So, the kind of risk reward ratio, I know a lot of people will be sitting on this call thinking, well, it's about time the brands kind of had their comeuppance a little bit on management contracts. But it has shifted, and it needs to kind of find its new level. Just to specifically address David's point on ESG, I've actually now signed 2 management agreements where we've had specific operational reporting clauses relating to ESG. So in the same way as we have to report on our financial performance, ESG clauses have been included for reporting purposes, and that was very much driven by and negotiated by the lending organisations for both of those deals. And certainly, last week I was at the Manchester conference. There was a very interesting conversation led by Karen Friebe there about ESG and how we're going to see that more and more coming into management contracts. I think one of the problems is we don't have an industry standard. We don't have a playing field at the moment, and everybody's trying to work out where they need to be and how this thing is going to work itself out. So I don't necessarily think it's so much the brands aren't doing anything. I think we're just kind of feeling our way, and nobody wants to put themselves out there as being out of market. So it's actually quite a tricky issue, but one that's clearly very pressing for us as an industry.
Thanks, Felicity. Philippe, I guess coming to you, just
yes,
I saw your hand go up.
I think the major change that we are seeing is almost the interruption of new builds for hotels. At least in Western Europe, very, very few projects are coming out. Why? I mean, yield expectation from investors have increased together with inflation, interest rate increase. Construction costs are 20 to 25% higher, and debt costs 3 times more than it should cost, like it was a year and a half ago. So the new construction of hotel is paralyzed, and therefore it's extremely difficult for operators which are operating on the basis of a lease model to satisfy lease yield requirements higher with construction cost higher with higher debt. The equation doesn't work anymore, and therefore we have a difficulty. And no matter which business model we offer management contracts, we try to make it work, because we try to build things which are bankable, of course, together with our partners, operators, and investors. And at the moment, it's paralyzed. So what we do, all of us, Felicity and others, operators, we focus on existing hotels, basically, for growth. And therefore, it's much easier for owners, operators, when they acquire the hotel, they have historical data, and they can manage to find their way with a lease or management agreement backed. So that's, I think this is the big change over the last year and a half. Of course, it is indirectly from COVID, but mainly this massive change in yield rates and interest rates, which is affecting our industry.
Yeah, everyone's trying to adapt to that, aren't they?
I mean, that's just a wider issue across all real estate, right? It's not, hotels are not the only ones.
It's not hotels only, of course. Yeah.
Yeah, it's the whole real estate sector is impacted by those trends, right? So we're seeing that everywhere really, and it means there's going to be more focus on conversions and things like that, right? So when we're looking at deals, looking at developments, it will be office conversion or something, right? It will, rather than necessarily being new build, because new build isn't going to work in the current environment.
And it's good to recycle building for the environment, by the way.
It is, yeah, it is. It is.
Amazing.
I think we have Sabina back on now, which is great. So they suffered a power cut at an inopportune.
I hope not another one. It was perfect timing, the whole building.
Yeah. Yeah, look, it'd be great to get your perspective, I guess, and what are you seeing in the market right now? What's changed? What's different?
I think what we see in the market, especially for us, a great opportunity to take over assets that have struggled during the pandemic. It's sort of slowly coming out of that, and owners are looking at a strategy going forward. However, they might not have the funds, you know, to put the required capex in, for example, to get them ready for a brand to take over. So it's a great opportunity for us to come in, because, you know, we can take over assets as they are, even, you know, if they might not be to international brand standards. We can then work together with the owner and find a solution going forward. We can then work together on a capex plan. The capex plan can be implemented over a certain period of time. Plus, us, you know, being such a large operator gives comfort as well to the banks or whatever lender they have on board for that capex. And then we can together then start speaking to the brands and see what's the best solution. Or sometimes, you know, the best solution might be to keep it independent for the time being. So we're not, you know, necessarily competing with the brands. Obviously, we're working very closely. We've got in total about 80 sub-brands across the world. So we really work with everyone, and we just see there's obviously not one fit all approach. We can, you know, go up to an asset, see what it needs, and then brand it accordingly, whatever it may be. Maybe the other point where I see a big shift, especially since the pandemic, is we're going much more upmarket, like Chris mentioned in his presentation. So historically, you know, we managed a lot of more mid-scale type of hotel, select service, and there's a strong demand now for going much more luxury. So we do have, you know, 5-star assets, beautiful assets, and there's many more brands now available in that market that weren't available before, because there's a certain amount of trust that had to be built over the years. You know, we have a strong track record. So, for example, some of the big global brands give a certain luxury brand on a franchise basis, which they might not openly advertise and they might not offer to anyone out there. But if they have, you know, good relationship, which, you know, we have with Hyatt, we have with Accor, obviously also the other ones, you know, we work together, and we can ensure that we maintain those high levels of standards that they require for their brand.
And that's an interesting point, because that's come up on the chat. Actually, I'd like to come to you, Felicity, on this point. You know, previously the assumption was always that you know, franchise was very common in that you know, kind of mass market hotel situation. But once you got up into the 5-star, the luxury, the resort style hotels, that was very much the purview of the brands and the hotel management agreements. Is that changing?
I think it is to some extent. So Hyatt, you know, like many of the other brands, we have introduced a number of sort of collection brands. So we have a collection brand sitting into luxury called Unbound Collection by Hyatt. So, for example, we readily franchise that brand, and I think the majority of the hotels we've signed recently for Unbound Collection have been franchised. We do want to make sure that the operator is able to operate in that space. We haven't pushed that door on Park Hyatt, and neither can I see us doing that, nor on Andaz. I think we've got comfortable with a couple of operators on Thompson, and indeed, you know, we've actually put on some franchise agreements a sort of quarterly review process in place, where, when, you know, the operator might not necessarily have as much experience as we would like in that luxury segment, but we accept that they've probably got the capacity to get there, and so we've put some guardrails in on a quarterly review basis. So if that hotel isn't meeting the kind of customer expectation scores, etc., that we would expect, that we can actually, you know, help that franchisee to move the product to where it needs to be. And I think it's important that we do that, because, you know, when you join a brand, you want every hotel to be in a fairly tight bandwidth. And if you suddenly get the brand saying, I don't care who I franchise my brands to, then that's to the detriment of your other franchisees and owners within that brand collection. So I think it's important that we're you know, we make sure that the operators of our brands have the capability to do it.
Lee, how about you from an Accor perspective? What's your thoughts on that?
We do not franchise Raffles and Fairmont. We do franchise M Gallery and Sofitel. We don't franchise most of our lifestyle brands, Oxton, Mama Shelter, 25 Hours. And that's about it. And we happily franchise all our premium mid-scale economy brands. So we have enough to cover a large portion of the market with that.
But I think to both of you, and I mean it's sort of a wider. I mean, obviously, Philippe and I both used to work at another brand at one point in time. But
did we?
Yeah, maybe. It highlights quite a big challenge, right, as an owner, because you create, and I totally get it. I tell you, top end luxury, you want to control your brand as much as possible, right? It's got a huge value, and it's hugely important to control that. I think what the problem though is balance in that relationship. So often, and we don't have a lot of them, but those agreements often be very long term, effectively unbreakable. And so as an owner, you've effectively got one supplier you can deal with for the running of your asset, right? So, and so you've given it away, you know, it's a huge job that you've given to one party. And Felicity, you mentioned there the importance of, you know, customer service metrics and guest metrics. You know, owners care about that. Obviously, they care about the brand perception, but they also care about, you know, RevPAR and profitability. Right, at the end of the day, they want to look for return on investment. And I think typically that's the criticism that's levied at the brands, is that they're focused more on the brand than they are on the profitability. And I was saying that's a general criticism across the market that gets levied at the brands. I'm not saying that's, you know, for the people on this call, but that to me is the challenge, right? Is that you take one of these luxury brands and you end up with a position where as an owner you're kind of stuck, right? And I think that's why, yes, it suits certain owners. They want that. You know, there's a sort of trophy element to some of these assets, but it doesn't necessarily work for everyone, right? And I think that is a challenge. I think it's good to see that you've got Aimbridge coming in. Maybe it's more entry level. Like maybe it's not Park Hyatt, but maybe it's further down. I don't know, Jake, if you want to add anything to that.
No, I think you're absolutely right on what you're saying here. And so since COVID, we acquired 6 hotels. 3 hotels we have created. So we have acquired OpCo and PropCo, and we have created a lease contract, a reposition, and we'll create a lease contract. And it's also what's out there, what's the marketing, is what you're seeking and how can you get into that deal in terms of creativity. One thing that we have found, and I think there's a management agreement structure that we actually like, and that's when an owner and operator is completely aligned. So we met Axiom when we acquired Bath, and we have done 3 deals with them, not only because they are extremely locally knowledge and also very knowledgeable, they are flexible, but also very quick. So we have found an operating structure where we have a local operator in a global industry. Whereas I think depending on the hotel, it's the ideal situation of having an operating assets because it's a local industry, but also local sort of management, but the industry is global. And you get the distribution system of the brands you choose, but also you get a very, very competent operator.
I think you're right. Yeah, sorry, Sabina, you go.
I think it's a very important point, Jacob, that sort of local aspect, because that's something that we come up a lot. We're obviously very large, you know, we've got a big scale, but I think that can only help owners that in the fact, for example, we can transition assets within weeks. By the way, hot off the press, we just signed a deal, big deal in Spain. We're going to be in there in October. Now, if you're a small operator, you know, who can mobilize such a big team and ensure such a smooth transition, it's because we are large. We've got experts on the regional and corporate level that we can just draw in when necessary. We can have a task force until we sort of build the team, the owner that's required. You know, if you're small, if you're local, you might not be able to do that. However, we also appreciate that you need to have that local approach. So we have obviously Aimbridge EMEA that covers Europe. So it's not that, you know, the owner needs to call Texas for any request they have. We have Aimbridge EMEA, and we have local offices, and we have regional teams which oversee a certain amount of assets. So it's not that it's all centralized across the pond. And we see that's really, really important, you know, that the owner has a local contact and that our regional team has that local knowledge of knowing what's going on in the market and having those connections. So I think we do believe that we can, you know, offer a bit, you know, the best of both, and then obviously tapping into the distribution system of global franchisors.
So I'm just conscious of time. I'd like to ask one more question before I come to the wrap up, if I could. And this is going to start off to you, Jacob. And this is one of the themes we hear more and more, is that the broader real estate investment funds are switching on to the attractiveness of the hotel market. Some of this coming from, if you like, allocating away from more traditional sectors like office or retail, which have had well-publicized issues. With that new money coming in, obviously those funds are very used to leased models. Is there going to be enough opportunity for them to invest in leased assets, or are they going to have to get their heads around franchise management agreements, etc.?
Often when we're seeing a leased property being sold, so you're buying the lease, or is a variable, is a big, we can compete because you have other operators that, or other real estate owners that can pay more for that. The one thing that many of these new players do not have is the ability of taking on operational risk in making a lease, or sort of constructing a lease contract from an operating hotel. So, and that's been for the past 5-6 years. If there's a variable lease out there with, we normally can't compete on price. What we can compete on is the creative path to getting a lease at the very end. And that's our sort of main bread and butter. It's operating sort of variable lease structures. And we love them. And we've loved them from the very get-go from Pandox. And we will continue loving them.
And Sabina, from your perspective, do you see more of these investors coming into the market now and seeking you out, and you're having to be a bit more flexible in terms of what they need from an investment?
Yeah, what we've seen is that there's a few sort of new players, and I think we just need to be more creative, you know, in the way that we structure our HMA, or like I said before, I think just as I was being cut off, you know, we have Lease partners with Borealis Hotel Group. We work very closely together. You know, we've done this over a long period of time. Something else that maybe hasn't come up yet, there's also owners that want to get into the business, maybe through their new generation coming into the business, or due to other reasons because they discover how exciting hospitality is, but they're not quite ready. So we have a few owners, partners that we're working with to create sort of a longer term strategy. So what will happen is we'll develop the hotel together. They will obviously own it, but we come in, help them with the on the technical side with the pre-opening, and we'll run it for the first couple of years until they are ready to operate it themselves. It's almost a little bit of a training period, and sort of a bit like a franchise in a way, and also helps them getting very good brands on board that would otherwise not be comfortable with them because they lack experience. So I think that's another interesting angle. So we run it maybe for 5 to 10 years, and then they're ready to do it themselves. So we've seen that more and more coming as well.
Okay, thank you. So I really appreciate everybody's comments and input on that. I'm going to close with just one final question before I hand to Russell, just to close the webinar itself, and that's we cast your mind forward 5 years. Is there one thing that you could point to, do you think, had been a permanent change post-pandemic, or is it a case of everything changed but everything stayed the same? Felicity, coming to you first, anything you think that is sticky out of the changes we've seen?
Specific to the pandemic, or just in the environment that we're in? Because the environment is hugely changing, and that's not necessarily a pandemic related. Either something that's we've learned it's changed, it's going to be still with us in 5 years. Well, I guess if you want to put something that's very specific to the pandemic, then what we're seeing in terms of leisure travel, people wanting to really go full out when they experience leisure travel. We've seen at the top end of the market a huge increase in people willing to take suites. So, the old adage of, you're giving away your suites in the loyalty program, that's kind of gone now. We're really seeing the ability to leverage suites in a way that we haven't been able to. Is that a lasting impact of the pandemic, or is that just a short-term impact? I'm not entirely sure. I'd like to think it's going to be lasting. But I think in terms of the industry, there's a ton of changes to come relating to environment, people's attitude to travel. How much are we all going to want to get on aeroplanes, and are destinations going to change, whether they're serviced by trains, etc. I think it's an enormous question with 3 minutes to go. Philippe, how about you? Anything that stands out you'd point to as being sticky?
I think we need to be agile and adapt to this changing environment and current economic changes. The results are great. In hotels today, the performance is outstanding. 2026 is going to be a record year, but a lot of question marks coming all over the place about all kinds of things, geopolitical, inflation, interest rates, and all that. So we need to be agile and ready to adapt to these changes. So that's my
Jacob
advice.
I guess with the fear of it being sticky, going into COVID, the Swedish football team was actually quite good, and I fear that we will hopefully win one game within 5 years. But that's because we've been dreadful performance. I think it's COVID related. So now I think geopolitical risk as a topic could be very interesting on the various political spheres. It's quite interesting how travel continues, but that's a 5 year apart from all the items that the COVID was an accelerator for. So it's sort of a time machine in many of the trends, but interesting times.
Thank you, David.
Yeah, I think I agree with that point on macro risk. It's much bigger now than it was pre-COVID, and to me that points to shorter term agreements, more flexible agreements. That is something I want to see. I hope we see that, and that will allow the sort of a better alignment of interest, right? It ultimately comes back to that. That's where we need to go with it. But I think COVID is an accelerator. I think is spot on, right? It's accelerated quite a lot of those trends, and we are now though in a macro part of the cycle, which has where we need to retain that flexibility as much as we can.
Thank you. And then finally, Sabina, and then I do need to hand over to Russell.
Yeah, I think similar to what David said, it's all about flexibility. It's about collaboration. It's about having an open dialogue. And I think a lot of companies, and that's brands, operators, owners, learned that during COVID, we have to talk together. We're all in it. And at the end of the day, it needs to be a win-win situation for everyone. It should not be a contract where only one party will gain, because, that's just not going to work going forward. So I think that's here to stay and should stay.
Right, thank you, and thank you all. That's been a really great discussion. I'll hand back to Russell now to close out.
Well, Graeme, wonderful job. managed the time almost to perfection, except you didn't leave me the 5 minutes that I had asked for in order to do a better wrap up than you're going to get. So may I thank Graeme, may I thank all your panel, David, Sabina, Philippe, Felicity, and Jacob. Lovely to see 2 HVS alumni in that team as well. As before, you leave me no option than to present a written summary, which I will distribute in the next few days, of what my key learning points were. But I hope that everybody has thoroughly enjoyed the webinar today. Thank you to our earlier presenters, to Karen, to James, to my colleague Chris, who finds himself in Sydney today, and James, you were in Greece as well. So a truly global webinar, if ever there was one. Ladies and gentlemen, thank you for joining us again. Most grateful to Izzy and Chris at EP for really managing the technology against some pretty difficult circumstances. But thank you for joining us. We will be with you again in the next few weeks with another topic that I hope we will get, again, a record turnout. So have a very good day. Enjoy the rest of your day. And thank you for being with us. All the very best.